Check. Good morning, students. Everyone, guys, hear me? Good morning. All have your note. Going to be a marathon series. All the conductor and score good marks. Lots and lots of practice. Also, lots of things. This this marathon not only about just understanding the steps or watching, how to attempt, it, but we are also practice some of the from every chapter. Okay, for then I'll try to make it as much as interactive as possible. So with me, sitting and just production started a and finance more than 50 by and South. Tech. Check. Okay. Yeah. So start with marathon. I believe that you are done with entire finance at least once. Bit of rest you leave up to me. Starting today with our very first chapter, that is going to be a ratio analysis. Have changed. Must be aware that some very dynamic as well, right? More well in FM, you past track their case studies MCQ. So, and the best way to crack your case have one thing, and that for are clear with, then you able to crack your very, 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 very easy. So majority practical, and what you can start with your of the question for your majority study. Anyone of you have learned their first experience? Fine. So guys, let's start your financial. Now see, before we are starting with the revision of this particular subject, all should, what is the objective of finance? Why are we studying this entire subject as a whole in your examination? Why? Because can I say financial management entire subject deals with management of finance for which type of entity? Are we going to learn financial management, sole proprietorship, partnership, or from companies? Come on. From which perspective? Company's perspective, right? And who is the financial manager of a company? Yes, come on, yaar. Who's the financial management? CFO, Chief Financial Officer. And is the Chief Financial Officer involved in decision-making process? Come on, yes or no? Yes. Okay. So a CFO is involved in the decision-making process. And there are 3 types of decision which a CFO makes. How many types of decision does a CFO make, beta? 3 types. The first type of a decision which a CFO makes is called as your capital structure decisions, which are also known as your financing decisions. Okay. So the first decision which a CFO makes is a financing decision. The second type of decision which a CFO makes is called as your investment decision. And the third type of decision which a CFO makes is called as your dividend policy decisions. Okay? And the entire subject of FM revolves in these 3 types of decisions. The first one is what? Financing. The second one is what? Investment. And the third one is what? Dividend decision. Dividend policy decision. Right? So, you have chapters of capital, cost of capital, leverages, etc. Can I say that will be forming part of your capital structure decisions? Come on, yes or no? Yes, sir. Then we have chapter of ratio analysis, investment decisions. Then, some part of receivables management, cash budget, etc. That will be part of your investment decision. And then we have dividend policy decision. That is whether we should distribute your dividends or not, because every decision making which a CFO does has a particular objective in it. So what is the objective? Can you all tell me? What is the objective, that why a CFO makes, with what objective which is kept in the maximizing dash what? Wealth of equity shareholders. I just profit maximize. No. Profit maximization is not the objective of a CFO. And profit maximization, wealth maximization are 2 separate things. This is one of the institute theory question, the difference between profit maximization and wealth maximization. Profit maximization is very short term from the company's perspective. Come on, yes or no? Yes, sir. And wealth maximization deals with what? Enhancing the wealth of dash shareholders, but I would say enhancing the wealth of equity shareholders of the company. Why? Because can I say equity shareholders are the true owners of the company? Come on, yes or no? Yes, sir. So the basic objective is to maximize the wealth of equity. Okay? The entire subject, you are only and only going to make decisions, and the decision making process is to maximize the wealth of equity shareholders. How does the wealth of equity? When there is increase in earning per share, but that's okay. But can I say along with increase in earning per share, there is also a necessity that there should be increase in the market price of equity share. Come on, yes or no? Yes, sir. Because let's say, for example, if a CFO is making decisions in which the EPS is increasing, but the PE ratio is falling. Are you aware about PE ratio? PE ratio is price earning ratio. So if the EPS is increasing, but if the PE ratio is falling, then can I say the market price of the share will not enhance that particular? So the basic objective is to maximize the market price of an equity share. So when the market price of an equity share will increase, can I say that the wealth of equity shareholder will also increase? Come on, yes or no? Yes, sir. So guys, you just have to understand only one most important thing in financial management, and that is how to maximize the wealth of equity shareholder by increasing the market price of an equity share. Just to summarize, entire financial management deals with management of finance from whose perspective? Company's perspective. And who manages the finance? CFO. Is he involved in decision making? Yes or no? Yes, sir. How many types of decision does it make? 3 types of decision. The first one is financing. The second one is investment. And the third one is dividend policy. With overall objective of dash, maximizing the wealth of equity shareholders. Okay. So now, based on these objectives and based on these concepts, we will start today with our first chapter, and that is going to be ratio analysis. So we are going to study each and every chapter. Okay. Sessions, we are going to study each and every chapter. Nothing will be left unleft. Everything you are going to, study concept wise, and I will help you to correlate that with study module as well, that you will understand concepts are also getting covered. Now, the first chapter, which is favorite, that is your ratio analysis. You will always expect question on ratio analysis. Okay. And examination weightage is between 5 marks to 10 marks for this particular chapter. I hope you are trying to understand that out of 50 marks, 10% to 20% can come from this particular chapter. So this chapter, I will invest more time as well. Okay. And this chapter is going to be your base for all the other chapters as well, because ratios is something which will be used subsequently also. Now, when it comes to ratios, I know the biggest problem is that right now you'll be able to understand it, but in examination, which ratio to apply when and what should be the constituents of that particular ratios, that becomes a difficult. So today we'll be sorting that out. That's why what I've done is I have classified, first of all, in ratio analysis, 37 important ratios. Okay. So how many ratios are we going to study today, beta? 37. Students are looking at each other. 37. Okay. But 37 ratios we are going to do today. And of course, some of the questions based on that. Now, I have classified the ratios into 3 main sets, and then there are some other important ratios we don't classify in this. So the first set of ratio which we are going to start today is called as your balance sheet ratio. What are they called as, beta? Balance sheet ratios. Now in balance sheet ratios, your numerator and denominator obviously comes from where? Balance sheet. That's why we call it as what? Balance sheet ratios. Okay. Then there is something which is called as your P&L ratios. And P&L ratios, numerator, denominator, both will come from where? P&L. Obviously, that's why they are classified as your P&L ratio. And then we have something which is called as your mixed ratio. And in mixed ratios, your numerator comes from your P&L and your denominator comes from your balance sheet. So how many main sets of ratios, guys? 3 main sets. The first one is your, second one is your, and the third one is your mixed ratios. Okay. Now balance sheet ratios, guys, is also solvency. Because when we look at the balance sheet, we are actually trying to check what is going to be the solvency position of the company. Come on, yes or no? Of course, yes. Focusing on solvency position. Because of course, when you are checking the balance sheet, what are the components of the balance sheet? Assets and liabilities. When you check assets and liabilities of any person, what you are trying to check is how much solvent he is, right? And you'll always wish what should be greater than what? Asset should be greater than liability. Then we say that the companies are solvent. Okay? So, solvency ratios is something which we are going to start with. Now, why I'm telling you this as well, because sometimes institutions can just give you P&L balance sheet and they will tell you calculate solvency. So then you should know that in solvency ratios, there are 7 important ratios to help us to determine the company. Now, the first ratio is everyone's favorite, and that is nothing but something which is called as your current ratio. Come on here. Okay, I'll tell you to make notes of this as well, but wait a second. Right now, just the first set of ratios which we have is called as your current ratio. Current ratio, guys, what's the formula? Okay, so that's nothing but your current assets upon your current liability. Okay, now can you all please tell me what are current assets? The assets which can be dash. It can be turned into cash within a period of dash 1 year, right? What are the components of current assets, everyone? Stock, debtors, prepaid expenses, cash, bills receivable, bank, all those things will be forming part of your current assets, debtors, etc. And current liabilities, what? Creditors, bills payable, outstanding expenses, and all those. And there is a standard ratio for it. What's the standard ratio? Of course, it's going to be 2:1, right? Because for every 1 rupee of current liability, we actually want double current assets. Come on, yes or no? Yes, sir. And will that help you to measure the short-term solvency position? Come on, yes or no? Yes, sir. Okay. So, why do we use the word short-term solvency? Because here there are assets and liabilities which can be converted into cash within a period of 1 year. Okay. That's why we call this as your current ratio and also short-term solvency. Guys, in examination, this ratio, lower the better or higher the better? Of course, higher the better, right? Because higher the current ratio, what does it signify, beta? Can I say that the company is more short-term solvent? Come on, yes or no? Yes, sir. But I'll tell you one disadvantage of a current ratio. If the ratio is extremely high, then it means that the company is inefficiently utilizing it. What is the company doing, beta? Inefficiently utilizing the funds. Because keeping too much of money in the form of your current assets, that is keeping too much of money in your stock, receivables, cash or bank, can be sometimes hazardous for the company. Okay? Can lead to overstocking, it can lead to more bad debts, etc. It is inefficient utilization of funds. Why I'm telling you this? Because sometimes they can ask that amongst the following, what can be the disadvantage of a current ratio? So one of the current ratio disadvantage is what? If this ratio is extremely high, it leads to dash. It leads to inefficiency in utilization of funds. Come on, yes or no? Yes, sir. Okay. And also current ratio helps you to get your working capital also. What's the formula of working capital, guys? Current assets minus current liability. So with the help of this current ratio, we can also calculate your working capital, which can be CA minus C. And this current ratio is also called as your working capital ratio as well. If suppose in a question you find there is something which is called as working capital ratio, then can I say that working capital ratio is nothing but your current ratio? That much you have to understand. Okay? Then current ratios, smaller brother, okay, is called as your quick ratio. And quick ratio, another name is asset test ratio. Okay? And guys, of course, what will be the formula for this quick ratio? Quick assets upon your quick liability. Okay? But guys, when I talk about quick assets, what are quick assets? Okay, current assets excluding your stock and prepaid expense. I agree with you. But what are quick assets which can be converted into cash in the short term way or in immediate manner? Then the answer is immediate manner. Okay. So your quick ratio is nothing but current assets minus stock minus prepaid expenses upon what? Current liability. Because we are talking about those assets which can be immediately which can be immediately converted into what? Into cash. It can be immediately converted into cash without loss of time or value. Okay. So let's say, for example, if you have stock with you, first of all, is stock part of your current asset? Right? Because stock sold within a period of what? 1 year. But you can't convert stock immediately. Because if you want to convert stock immediately to cash, either you have to reduce its value and sell it, or either you have to wait. Stock can't be sold immediately into cash, right? Because if suppose I'm a retailer, and I'm having a showroom where I'm selling garments. Okay, so can I say my stock of finished goods garments? Come on, yes or no? Yes, sir. Now there is so much of stock. If I want to sell it tomorrow, is it possible that I can sell it immediately? Is it possible? No. But if I want to sell it, it is possible, but with loss and dash value, right? So when I want to convert stock immediately in cash, it is possible. It is possible, but there is going to be loss of value, right? So that's why we will always treat stock as your dash. Quick asset or non-quick asset? Non-quick asset. Because if I want to convert stock into cash immediately, then either I have to reduce its value. You all must be aware about the fact that whenever clothing brands, when they want to sell their stock, they'll always give flat 50% off. You know, have you heard about this? Flat 80% off, flat 70% off. So in that particular case, what is happening? They are converting stock into cash immediately. But are they losing value of it? Come on, yes or no? Yes, sir. So those assets which cannot be converted into cash, those are called as your non-quick assets. How many types of non-quick assets are there? Two. One is what? Stock, and another one is what, beta? Prepaid expense. For non-quick. And can I say all the current liabilities are quick in nature? Come on, yes or no? Yes, sir. What is the standard ratio of this? 1:1. Obviously, now the standard ratio will be relatively lower. Come on, yes or no? Yes, sir. Because we are removing some assets from the numerator. So that's why your standard ratio will also be relative. Okay, so that's why we have the second ratio, which is quick ratio. And that is nothing but current assets minus stock minus prepaid upon current liability. Okay. Then we have one more ratio which is related to this, which is called as your super quick ratio. And guys, this super quick ratio is also called as your cash ratio. Called as beta cash ratio. It was asked like in the last attempt only, cash ratio was asked. And cash ratio deals with what? It with cash plus bank or marketable securities, which needs to be divided by current liability. So what does this ratio tells you? That for every 1 rupee of current liability, how much is the liquidity right now available with you? So that is called as your cash ratio. How much liquidity is available with you? Okay. So in your cash ratio, there is no need for any conversions. Self is your liquidity which is available with you. And as a CFO, you all should know this, right? For 1 rupee of current liability, how much is the cash readily available and how much needs to be converted into cash, right? So that's why we have the third type of a ratio, which is called as what, beta? Super quick ratio, also known as your cash ratio. Okay, which tells you for 1 rupee of current liability, how much is the cash readily available. Okay. So first of all, are you all okay with the first three set of ratios, beta? The first one is what? Second one? Third one? Super quick ratio, also known as your cash ratio. Okay. First three ratios clear. All these three ratios should be lower the better, or it should be higher the better. Higher the better. But if suppose it is too much high, leads to what, beta? Efficiency or inefficiency? Inefficiency in utilization of fund. Extremely clear. Okay. Then we have something which is called as your stock to working capital ratio. Can you all please tell me what's the formula for stock? What is it going to be? Can I say it's nothing but your stock to working capital ratio? See, very easy. That some type of ratios comes which you have not encountered earlier. very easy to understand this. In the numerator, can I say there will be closing stock? Okay, because it's stock to working capital, right? So that's why it will be closing stock. And we will divide that with what, beta? Working capital. And what is working capital? As you all know, CA minus CL. Okay. Now, what is the objective of this ratio? This ratio will tell you that for every 1 rupee of working capital, how much is blocked in the form of stock. 1 rupee of working capital, how much is blocked in the stock. Now, why is this important? So let's say, for example, if I start with my own company where I have share capital of 10 lakhs. So I have got 10 lakh rupees by the way of cash. Come on, yes or no? Yes, sir. Now with this 10 lakh rupees, I have invested in fixed assets 7 lakh rupees. So how much is the cash bank available with me, beta? 3 lakhs. Can I say that 3 lakhs is my cash bank capital? Now let's say, for example, with this 3 lakhs, I purchased entire stock. On here, is it possible I can purchase entire stock? So I have purchased entire stock. Now is stock also part of current assets? Come on, yes or no? Yes. So stock is also part of working capital. But if I just check, my working capital is 3 lakhs and that entire working capital of 3 lakhs is in the form of what? Stock. So is there any liquidity or there is no liquidity, beta? And then if there is no liquidity, don't you think it will be little bit difficult for the company? You know why? Because when the company has to make the payment to labor, wages, etc., how can they make the payment if there is no liquidity left, right? I cannot tell them take my stock away, right? So that's why stock to working capital ratio will actually help you to understand that how much of the working capital is in the form of stock and how much is the liquidity part. Okay? So that's why the formula for stock to working capital is what? Closing stock upon working capital. Okay? And if this ratio is higher, then the liquidity is dash. Very good. If this ratio is higher, then what is the liquidity status? Can I say liquidity status will be 0, right? It will be lower, right? In my example, how much was blocked in the form of stock, beta? 3 lakhs. How much was my working capital? 3 lakhs. So the ratio is 1:1. So the liquidity is dash 0, right? So higher the stock to working capital, beta, can I say lower is going to be the liquidity? Yes or no? Yes, sir. So if stock to working capital ratio is higher, it means that liquidity is going to be lower. Do you all agree with this? Okay. Now, again, why are we discussing all these things? Because, you know, some ratios, interpretation asked in the MCQ as well, right? So if suppose this ratio is higher, then what does it imply? And they can give you variety options. Okay, and one of the options which you all should know, that if the stock to working capital is higher, it means that in this working capital, so much of money is blocked in the form of. So that is why the liquidity position of the company will be lower. Now, if I tell you that if the stock to working capital is 0.7:1, if the stock to working capital ratio is what, beta? 0.7:1. What does it mean? For every 1 rupee of working capital, how much is blocked in the form of stock? 0.7. So how much is the liquidity? 0.3 will be the liquidity. Okay. So that's how we'll be getting the liquidity position. So this is your fourth ratio. This ratio cannot be higher the better or lower the better, because it depends upon companies how much they want to invest in stock. But I will always recommend you chartered accountants that never keep stock to working capital ratio higher, because if you keep it too much high, then you will definitely face liquidity. Okay? Then we have the next ratio, which is extremely important, and again everyone's favorite, ICI's favorite as well, something which is called as debt upon equity. Have you heard about this? Debt upon equity. So debt means short-term debt or long-term debt. Always remember that debt equity ratio, in that the debt always constitutes your long-term debt. Give me some examples of long-term debt. Debentures. Okay? When I am taking bank loan from the long-term perspective, can I say that will be also be treated as a long-term debt, right? And I am going to divide this with what? Your equity. And your equity defines your equity shareholder funds. What is it defined, beta? Equity shareholder funds. Okay? There's a very interesting question given to you in your RTP of September 20, where there is a debt equity ratio, and they have actually given debt owners funds ratio. So if the chance, I'll be showing you that as well, where they have told you that the ratio is debt upon owners' funds. Okay. Now, when it is debt upon owners' funds, what does it lead to? Can I say it leads to debt upon shareholders' funds? And here in this ratio, what are we studying, beta? It is nothing but debt upon equity shareholders. Is there a difference between debt upon equity shareholders' funds and debt upon shareholders' funds? Yes or no? Yes. What is the difference? I'll tell you. Can I say in shareholders' funds, will also be including your preference share capital in it? Come on, yes or no? Yes, sir. And in debt equity shareholders' funds, because in one and private limited, which they have treated debt equity as equity shareholders' funds, and here will they include preference shares or no preference shares? Beta, no preference. So we will come to that, but first of all, debt equity ratio, what does it try to tell you? It tells you that how much money they have taken from outside and how much is your own money, which is being invested in the business, right? So equity shareholders funds has three important things. Okay? The first one is actually called as your equity share capital. The second one is called as your reserves and surplus. And to this, I subtract something which is called as miscellaneous expenditure not written off. Are you aware about miscellaneous expenditure not written off, right? So these are preliminary expenses, right? Discount on issue of debentures, which are not written off, but it will be certainly written off in future. Now, when it will be certainly written off in future, what is going to be the consequence of that? Equity shareholders funds will reduce. Come on, yes or no? Yes, sir. So always remember that when we are buying equity shares of the company, you have to think that you are going to be the owner of this particular company. Okay. So when you are going to be the owner of this particular company, you are going to check whatever is the equity share capital. Also, you are going to check what is going to be the accumulated profits. And also you are going to check whether there are certain miscellaneous expenditure which will be written off that needs to be subtracted. Okay. Give me the examples of reserves and surplus which will be forming part of equity shareholders funds. General reserve, P&L account, securities premium account, even capital reserve will be forming part of it. Okay. So any reserves which you check, will it be forming part of your equity shareholders funds? Come on, yes or no? Yes, sir. Okay. Now, this ratio should be higher the better, or this ratio should be lower? What do you think? Debt equity ratio. What do you think? This ratio should be higher or lower? Because this should be lower the better, as this helps you to understand the financial risk in a particular company. If this ratio is high, what does it indicate? That you are taking more and more dash in the capital structure. You are taking more and more debt in the capital structure, right? And when you keep on taking more and more debt in the capital structure, then can I say the financial leverage of the company also increases, right? So one of the way to measure the financial risk in the company is the help of a debt equity ratio. Okay? And you'll be amazed to know that in finance, there are many ways to measure the financial risk. One of the way to measure the financial risk is debt equity ratio. One of the way to measure the financial risk is capital gearing ratio. Capital gearing ratio. One of the way to measure the financial risk is financial leverage, which we'll be studying in the next chapter. One of the way to measure the financial risk is financial break-even point, which will come in the capital structure chapter. So there are multiple ways to manage and understand the risk in a particular company. And one of the way to manage the risk in the particular company is, can I say, with the help of a debt equity ratio? Come on, yes or no? Okay. So debt equity ratio is debt upon your equity shareholder fund. Okay. This ratio from the examination perspective should be dash, higher the better or lower the better? Lower the better. Are you guys trying to understand this? Okay. But there is a standard ratio. And the standard ratio for this is 2:1. So they tell you that if you want to take risk, then take the risk in a particular company, but it should not exceed dash 2:1. And 2:1 is the maximum proportion of the debt which should be against your equity. And yes, you should take debt for faster expansion and growth, provided your leverage is favorable. Now, why do I say that the leverage is favorable? Leverage can be favorable when you are earning more return as compared to the cost of debt, right? So if suppose you are taking loan at the rate of 7% and you are going to earn 15% by the way of returns, then is it okay to take loan in the capital structure? Come on, yes or no? Yes. Why? Because the returns is greater than the cost. But if you are taking loan, then be in your limits. The limits is what? The standard ratio should be 2:1. Okay, don't misinterpret this as 20, because Vijay Mallya did that. And you know what are the consequences? Then you have to leave. So always remember that if the debt equity ratio is extremely high, then it leads to insolvency. Come on, yes or no? Yes, sir. That's why debt equity ratio should always be in the examination. Lower the better. But still, if you want to maintain, what is the standard ratio? 2:1. Then we have something which is called as capital gearing ratio. Have you heard about this? Capital gearing ratio. By the word gearing, what does it mean? The word gearing actually means dash, risk. What does the word gearing means? Tell me, beta. It means risk. Okay. But now, what is the risk here then? Because in debt equity ratio also we were measuring some part of risk. In capital gearing ratio also we are measuring risk only. But capital gearing ratio, what is the basic the word? Here we are talking risk from perspective of how much money you are raising from fixed financial securities divided by how much money which you are raising from non-fixed financial security. Okay? We are going to deal with fixed and non-fixed. We are going to deal with fixed and non-fixed financial instruments. Okay? Now see, you have taken money from debenture holder, preferential, you have taken bank loans. So don't you think you are enrolling yourself more from the fixed obligation perspective, right? Because to the bank, what do you have to pay, beta? You have to pay interest. Then also, you also have to pay to debenture holder interest. You also have to pay preferential holders preference dividend. Now more, you are involved in your fixed financial company. More is the risk. Come on, yes or no? Yes, sir. So basically in capital gearing ratio, what are we actually checking? That how much money we are taking from fixed sources. So that's why we have something which is called as debt and preference shares, and we divide this with equity shareholder fund. Debt plus preference shares upon equity shareholders fund. Can I say this will help you to understand how much money in the numerator we are taking from the fixed sources, because debt is fixed. Come on, yes or no? Yes, sir. Right? Equity shareholders is non-fixed, right? So we will take debt upon non-fixed, upon whatever is your equity shareholders funds, so that we come to know that how much is the risk. Now if this ratio is very high, then what does it mean, but if this ratio is very high? Can I say risk is relatively higher? Because I have taken so much of money from debenture holders, from preference shareholders, from bank loans, so I have to give them some fixed commitment. So in that particular case, if this ratio is extremely high, that risk involved is also going to be relatively high. So capital gearing ratio, also the same concept, beta. This ratio should be higher the better or lower the better? Lower the better. Absence of debt in capital gearing. So if I don't have debt, if I don't have preference shares in the capital gearing, so my capital gearing ratio turns dash rate. Can I say it will turn out to be debt equity ratio? Yeah? Because if there is no preference shares, then debt upon equity. Correct? So are you all okay with this sixth ratio also? Come on, yes or no? Yes, sir. All these items, can you all see? They are coming from your balance sheet. And then if this ratio is very high, then what we will judge, beta? You will judge that there is too much of risk. So that's why, if this ratio is extremely high, then can I say there will be insolvency? Come on, yes or no? Yes. There are chances, because you are involving more and more self in your fixed commitment part. Okay. And then we have the last ratio in the balance sheet ratio, and that last ratio is actually called as your proprietary ratio. Okay, what are they called as, beta? Proprietary ratio. Proprietary ratio. Proprietors funds are also known as your shareholders funds. What are proprietors known as, beta? Proprietors are known as shareholders. Okay. So your proprietary ratio actually deals with your shareholder funds, which I need to divide it which I need to divide it by the total assets. Now look at my wordings, beta. Can I say the wordings are shareholders fund? Now, which elements will come in the shareholders fund? Equity share capital plus preference share capital plus reserves and surplus minus miscellaneous expenditure not returned. Come on here. And your total assets actually deals with what? Fixed assets plus long-term investments plus current assets. So this will be part of your total asset. These are the elements. Acha, tell me one thing, if ratio is higher, what will you interpret? Does it deal with lower stability or higher stability? If this ratio is higher, what does it indicate? Lower stability or higher? Lower or higher? Of course, it leads to higher stability. Why, beta? Because means that on every 1 rupee of asset, there is more of own funds which is involved. Now, when for every 1 rupee of asset, if more of own funds is involved, it's a good thing. Why it's a good thing? But if more funds is involved, which is actually your own funds, then debt is less, and then the consequence of that is, if sometimes there is a recession cycle, still no one will touch away your assets. Your asset still belongs to you. So that's why if this ratio is higher, indicates long-term stability. So what does it mean? That this lower the better, or this ratio should be higher the better? This ratio should always and always be higher the better. Okay. So are you all okay with this first 7 ratios which we have done? Okay. So all these ratios deals with what, beta? Long terms, all this ratio deals with the solvency position of the company. Come on, yes or no? Yes, sir. Clear, everyone? Okay, absolutely clear. Purinjida. Okay. But even I also know. So now, what do you want to do? You want to quickly of this? Then quickly let us fast. Let us make Vikrama. Okay, we'll write down this, and then we'll continue further. Okay, guys. Or else, can I do one thing? I'll give you source of this, and then you can download this particular thing. Okay. Will that be better? Because so that you all don't waste time writing this, cover more and more things, because we have limited time. Fine? Then you can download it. My handwriting, I think, for you to understand. So these are the first 7 ratios. Okay. Now the second set of ratios. As I told you, the first one was your balance sheet ratios. Okay. So these one were your balance sheet ratios. And then we have the second set of ratios. And what are the second set of ratios, guys? P&L ratios. Okay. Okay, just somewhere if you feel that you want to make a note of something which you feel is very important, then you all can on your own. But just don't waste so much of time in writing everything what I say, so that you miss listening. I recommend that much. Your ears to me properly. Then we have the next set of ratios, and that is your P&L ratio. Numerator, from where it will come? P&L. Okay, by the way, in P&L actually means your manufacturing trading. And your denominator also comes from P. So P&L ratios are one of the most easiest. Why? Because these ratios, everything comes from your trading P&L account. Okay? And some of the ratios which you already know in your P&L called as G. Have you heard about GP ratio? Okay, and GP ratio, if no information is given, is always based on dash. It's always based on sales. But there is a question where they have told you that GP ratio is based on cost. But if no information is given to you, then GP ratio is always based on dash, beta. Based on sales. Okay. Now please tell me GP ratio. What's the formula, beta? Gross profit upon sales into 100, right? Then again, something which is called as net profit ratio. Now there is always a confusion in students' mind that if the word only net profit is given to you, then what should we interpret that net profits as? Then those net profits are always your net profits after tax. Always remember. So whenever you see net profit ratio, what does this ratio of net profit tells you, beta? It always tells you net profits after tax. Okay. So net profit ratio is NPAT upon sales into 100. Okay, NPAT upon sales. And then, my dear students, we have something which is also called as our operating profit ratio. So, operating profit ratio. Operating profit ratio, guys, give me the formula. EBIT. Because in finance, net profits and operating profits are two separate things. Can you please tell me what are your operating profits? Earnings before interest and tax. So it means that we have just considered from sales, we have subtracted COGS, and then we have just subtracted operating expenses. Get something which is called as your EBIT. EBIT, can I say it's nothing but your operating profits? Okay, earnings before interest and tax. Hello. Okay, so these are your operating profit, because interest in finance is always treated as your which type of expenditure? Beta, financial expenditure. What is interest treated as? Financial expenditure. It's not your operating expenditure. Huh? Operating expenditure examples are rent, staff salary, electricity, warehouse expenses, administrative, selling and distribution, salesman's commissions. All those things will be coming part of your operating expense, right? But when it comes to your interest or preference dividend, all those will be treated as your financial expenditure. Okay. Tell me, what is the formula for operating profit ratio, beta? EBIT upon sales into 100. Okay. Then, what do you think will be the formula for administrative expense? Administrative expense. Of course, administrative expense ratio will be nothing but administrative expense upon sales into 100. No, admin expense ratio is nothing but administrative expense upon sales into 100. Because when I talk about administrative expense ratio, we are talking about the items which come in your P&L account, which deal with your office administrative expenses, which compare it with sales. Then what about selling and distribution expenses ratio? Tell me, selling and distribution expense ratio will be what? Selling and distribution expenses upon what? Sales into 100. Okay. And then admin expense, selling and distribution expense. And then we have something which is also called as operating expense ratio. Now, what is operating expense ratio, beta? We will take the list of operating expenses upon sales into 100. So they will give you in the question that these are the list of operating expenses, and they will tell you to calculate operating expense ratio. So I can take operating expense and divide that by sales into 100. I'll be getting operating expense. Okay. But first of all, please tell me, the first three ratios should be lower the better or higher the better? Okay, all the profitability ratio should always be what, beta? Higher the better. And what about the last three ratios? This three ratio, this ratio, it should be lower the better. Okay, because all the expenses ratio lower the better. Now I'll give you one twist. There is something which is called as operating expense ratio. Now there is something which is also called as your operating ratio. Now operating ratio is different from your operating expense ratio. What is operating ratio? Now operating ratio is nothing but 1 minus operating profit ratio. Okay, what is it, beta? 1 minus operating profit ratio. Or as you told, it should be COGS plus operating expense upon sales into 100. Your operating ratio, come on, yes or no? Yes, sir. So you have to see the question. September 24. You can see the question. 24 or September 24 last, where there was operating ratio, which was, so operating ratio, is it different from your operating expense ratio? Come on, yes or no? Yes, sir. Whenever they tell you it's operating ratio, then it is nothing but 1 minus operating profit. Okay. So if your operating profit is 10%, then can you tell me what is operating ratio? 90%, which can also be derived by taking COGS plus operating expense. But sometimes they will give you a list of operating expenses, which I'll tell you in one of the questions. There you will just take the operating expense and divide that by sales. Right? That basis you will be getting the final answer. Okay. Everyone's clear till here? Okay. So this will be called as your operating ratio and operating expense. So operating ratio should also be higher the better or lower the better, beta? Operating ratio, come on, what do you think? Higher the better or lower the better? Because lower the operating ratio, can I say higher will be the operating profits? Are you all okay with now the P&L ratios? So these are the list of P&L ratios, where I told you the first three sets of ratios were regarding your profits, and the next three sets were regarding your expenses. Okay. Once again, everyone, GP ratio formula. Gross profit upon sales. Net profit ratio formula, NPAT upon sales. Okay, NPAT, use the word NPAT only, NPAT upon sales, because or else you'll be confused that which profit should I. Third one is your operating profit ratio, where I will take EBIT upon sales. Okay? And then we have admin expense, selling expense, and operating expense, and respective expense. Any damn expenditure you can compare with sales and calculate the expense ratio. All the things should also be lower the better. And is there a difference between operating ratio and operating expense ratio? Yes, sir. 1 minus operating profit will actually be operating ratio. Are you all okay with this? Okay. We are done with 7. Which ratio? Balance sheet ratios. Then we are done with your 7 P&L ratio. 7 balance sheet, 7 P&L. Okay. Now I'll be starting with mixed ratios. Okay. Now in mixed ratios, numerator comes. Come on, Solu. Numerator comes from. Denominator comes from. I hope you guys are trying to understand that first of all, both the figures are coming from two separate statements, right? And this is happening for the first time, because in balance sheet not occur, P&L not occur, in mixed ratio is occurring. So can I say that in your mixed ratios, numerator comes from where, beta? P&L, and the denominator comes from where? Balance sheet. So you all can just check that there is going to be some timing difference. First of all, you have to understand that. In this ratio, is there a timing difference? Come on, yes or no? Yes. Because numerator comes from where, beta? P&L. And P&L we always take it from 1st of April to 31st of. On yaar, P&L account is for the entire year, and balance sheet is as on a particular date, right? This is actually from 1st of April 2000 and let's say 24 to 31st of March 2025, right? And the balance sheet is only on 31st March 2025. So is there any need? Adjust the timing difference? Come on, yes or no? Yes, sir. I can't compare my full 1 year figure with just closing balance sheet. And that's why in mixed ratios, it is important that you have to take in the denominator some average. What do we have to take in the denominator, beta? Average. You have to take in the denominator some average. That's why the average will be from 1st of April 24 to 31st March. So that's why we take, can I say, opening balance sheet figures and closing balance sheet figures and take the average of it to eliminate the timing difference. And this is only to be done in which set of ratios, guys? In which ratios? Mixed ratios. You don't do averages for P&L and balance sheet because there are no timing differences. But whenever you see a mixed ratio, you can see now P&L comes from the numerator. So it's a full 1 year figure. And denominator only comes from balance sheet. So balance sheet we can't prepare for full 1 year. It's a financial position as on a particular date. So is there any need to adjust the timing difference? Come on, yes or no? Yes, sir. By taking opening and closing, divide that by. Will that give you the average? Come on, yes or no? Yes, sir. Okay. So in mixed ratios, when the opening figures are given to you, will always take the average. But what if the opening is given to you? Then closing itself is your average. Always remember, in entire finance, wherever you don't see opening figure available, we assume opening is, and opening is same as closing. So automatically that itself will become your average. So in mixed ratios, we have to eliminate what? Eliminate the timing difference. Okay. Now my dear students, we have to eliminate timing difference. Okay. But please tell me, this mixed ratios I will categorize into two main sets. The first set will be called as your turnover ratio. Okay. And the second set will be called as your return ratio. What it will call as, beta? Return ratio. Okay. Can you all please tell me what's the format of the income statement? Sales less, no, not variable cost. But in every chapter of FM, income statement has to be modified based on the requirement of that chapter. So in leverages chapter, I will take sales minus variable cost, contribution minus fixed cost, because there we have to check the impact of fixed cost, right? So that's why I'll prepare the format like that. Okay? In receivables management, there will be a different format. In ratio analysis, you have to understand it has to be sales less COGS. From sales, what will you subtract, beta? COGS. What will you get? Gross profit. Come on, from gross profit, what do you subtract? Operating expenses. What do we get? Operating profits. Operating profits are also called as EBIT. Okay, wait, I'll just make a note of this. Pay attention. From sales, what do you subtract, guys? COGS. What will you get? Gross profit. From gross profit, what do you subtract? Operating expense. What do you get? Operating profits. Come on, yaar. Hello? Operating profits. From this, what do you subtract? Interest. What do you get? EBT. From this, what do you subtract? Tax. NPAT, also called as your EAT. And then we will subtract preference dividend. What will you get, beta? Net profit for equity shareholders. From this, if you want, you can subtract equity dividends, and the balance part will be called as your retained earnings. What is it called as, beta? Retained earnings. Reserves and surplus, what we transfer it to reserves and surplus. For company, the profits which ultimately remains gets transferred where, beta? Balance sheet, and it gets transferred in your reserves and surplus. Last bench, can you see properly? So this is the format of the income statement, right? Now, based on this format, okay, first, what can be the first set of turnover ratios? I'll teach you what are turnover. By the word turnover, what is the general meaning of sales, right? So we are comparing sales with majority of. Let's say, for example, if I tell you my sales is 10 crores, and if Mukesh Ambani tells you that his 500 crores, so don't think that he is performing efficiently. Example, he has sales of 500 crores, but he has fixed assets which are 250 crores. So how much is the fixed assets, beta? 250 crores, and on that 250 crores, the sales generated is what, beta? 500 crores. So is he able to generate the sales twice of his fixed assets? Come on, yes or no? Yes, sir. My sales is 10 crores, but I have fixed assets of only 1 crore. Then with 1 crore of my fixed assets, if I'm able to generate the sales of 10 crores, everyone please tell me, I'm able to generate the sales dash times of my fixed assets. So who is more efficient? Of course me, come on, yes or no? Yes. So can I say that the turnover ratios takes into consideration the efficiency part of the company? Okay, so these are also known as what type of ratios? Efficiency ratios. What are they known as? Tell me, yaar. Efficiency. These are also known as performance ratios. Okay. So when they will give you a question and they will tell you that calculate the performance, they have just given, and they have to calculate the ratios. But then which list of ratios to be calculated? So if they have asked about efficiency, then we have to check efficiency. And if they ask about solvency, we have to look for balance sheet. If they ask about profitability, we can look about P&L ratios and also this return ratios, which I will teach you. Okay. So can I say turnover ratios help you to understand the efficiency? Come on, yes or no? Yes, sir. Fine. Now please tell me that this efficiency ratios, should it be lower the better, or lower or higher? This efficiency ratio should be lower or higher? Of course, it should be higher the better. Because if this efficiency is higher, it indicates that the company is utilizing its resources properly. So let me give you some of the examples of your efficiency ratio. The first one is called as your capital employed turnover ratio. Have you heard about the word capital employed? What is capital employed? The total money which is invested in the business. And the total money which is invested in the business can be from shareholders also, and it can be from your debt also. So that's why capital employed always means dash plus dash. Shareholder funds plus borrowed funds. Borrowed funds means your long-term debt. On yaar, it is nothing but shareholders funds plus your borrowed funds. Okay. Shareholders funds, can I say it includes 4 things? Whenever I use the word shareholder, it always includes 4 things. Whenever I use the word equity shareholders, it will always include 3 things. The difference between shareholder and equity shareholder is The existence of preference shares. In shareholders, will the preference shares come? Come on, yes or no? Yes, sir. Give me shareholders. Equity share capital plus preference share capital plus reserves and surplus. Very good. Minus miscellaneous expenditure not written off. Right? And shareholders plus borrowed funds will actually give our capital. Okay. Now, capital employed turnover ratio. So we want to check how much is the sales generated from the capital which you have employed. So that's why this ratio should be what, beta? It should be sales upon capital employed. Come on here. Sales upon capital employed. Okay. Can I say that? Does the sales come from the P&L? Solo, come on. Does the sale come from P&L? Does the capital employed come from a balance sheet? Is it a mixed ratio? And if it's a mixed ratio, do we have to eliminate the timing difference? How do you do that? Well, we're dividing that by average. That's how we'll be getting sales upon average. But yes, if closing only needs, and there will be sometimes some questions in which it is mentioned that ratios relating to capital will only be calculated at the capital at the end of the year. That is the statement which is given to you in the question. It means that, is there a need to do any average? No, sir. Okay. So this is your capital employed turnover ratio. Now you only tell me, what do you think will be your fixed assets turnover ratio? Come on. Sales upon average fixed assets. Okay, fine, very good. Give me working capital turnover ratio. Average working capital. Come on, guys. Also now give me something which is called as debtors turnover ratio. Sales upon average debtors. But wait. Debtors only comes because of credit sales, right? And when there are average debtors, there is also possibility of average bills receivable. Come on, yes or no? Yes, sir. So it can also be credit sales upon average bill. Awesome, guys. Okay. So on this basis, can I calculate my debtors turnover ratio? Come on, yes or no? Yes, sir. And debtors turnover ratio indicates what are the number of times the debtors will be converted into cash in a year. That is actually called as a debtors turnover. Now, if I tell you something like this, that the debtors gets converted into cash for 6 times in a year, means debtors are giving the payment for how many times in a year? 6 times. What is the debt collection period you have offered? What is your debtors collection you have offered? Can I say 2 months? Are yaar, if I give you 2 months credit, what's your name? If I give Divya 2 months credit period, if I give Divya 2 months credit period, then Divya will be giving me the payment how many times in a year, beta? 6 times in a year. So can I say that debtors turnover ratio can actually help you to calculate also your debt collection period, yaar? And if debtors turnover ratio is higher, it indicates that the company is giving lower debt collection period to its customers, right? So debtors turnover ratio can also help you to calculate which ratio, beta? Debt collection period. So can you please tell me what should be the formula for debt collection period, beta? 12 upon debtors turnover ratio. And if they ask you calculate debt collection period in days, then can I say I will take 360 or 365, and in case of weeks I'll take 52. Okay, and I'll divide that by debtors turnover. Okay, so from now on, whenever I tell you what is debtors collection period, you just have to tell me 12, 52 or 365, divide that with what, beta? Debtors turnover ratio. Okay, so now everyone please quickly tell me, if my debtors turnover ratio is 4 times in a year, it means debtors are getting converted into cash how many times in a year, guys? 4 times. So what's the debt collection period I'm offering? 3 months, right? If debtors turnover ratio is 6 times, if debtors turnover ratio is 2 times, if debtors turnover ratio is 12 times, can I say 1 month is my debt collection period? Okay, Purinjida. Okay, so debtors turnover ratio and debt collection period can be calculated simultaneously. And then if you want, you can apply debtors turnover ratio here in the numerator and then substitute and get the final debt collection period. Come on, yes or no? Yes, sir. But there are too many ways to understand this formula. One of the most easiest ways, if you know what is debtors turnover ratio, simply take the time period, divide that by debtors turnover ratio to get the debt collection. So now, all my intelligent students, please tell me what is creditors turnover ratio. Frame the ratio and tell me. Very good. Credit purchases upon what? Average creditors plus average bills payable. And of course, what will be your creditors payment period? 12 or 365, divide that with what? Creditors turnover ratio. And guys, what do you think your creditors payment period, should it be higher the better, or should it? Very good. Creditors payment period should always be higher. Payment period. Are guys, you all are going to become chartered accountants. When it comes to giving the payment, you should always search for a supplier who will give you lower credit or higher credit. Higher credit na yaar. Always try to search for a supplier who gives you higher credit at the same cost of goods. And when it comes to selling the goods, you should always find the customers who will give you the payment faster or lower. Faster. So a debt collection period should always be lower. On yaar. Debt collection period sikrama. Okay. And creditors payment period non-sikrama. Okay. So can I say creditors payment period should always be lower the better or higher the better? Creditors payment period. Higher the better. Debt collection period. Correct? So, see, this is actually exactly reverse. Debtors turnover ratio should always be higher the better. Because higher the debtors turnover ratio, faster the collection is. It means that the debt collection period should be lower. Okay? Creditors turnover ratio should be lower the better. It means that creditors payment period should be high. Superb, superb. Everyone okay? Okay. Then there is something which is called as stock holding period. Now you only create stock turnover ratio. You only tell me what's the formula for stock turnover ratio, guys. Stock turnover, stock turnover, stock turnover. Can I say this is nothing but COGS upon what? Average stock. Come on, yaar. COGS upon average stock. Will this give you stock turnover ratio? Come on, yes or no? Yes, sir. And if suppose, of course, COGS is not given to you, then we will take into consideration sales. Sometimes they will only tell you that calculate this ratio based on sales. So then we will take sales upon average. Got it? Okay. Can this help you to calculate your stock holding period? Come on, yes or no? Yes, sir. Give me stock holding period. 12 or 365 upon what? Stock turnover ratio. Okay. This is your ratio number 7, 8 and 9. Fine. So now everyone please tell me capital employed turnover ratio. Lower the better, higher the better. Capital employed turnover ratio. Come on. Lower, higher. Fixed asset turnover. Working capital turnover. Debtors turnover higher. Hence debt collection period lower. Then creditors turnover ratio lower. That's why creditors payment period higher. Stock turnover ratio. Come on. Because this indicates how much number of times your stock is getting converted into cash. Okay, or your stock is getting sold. So always be higher. And your stock holding period be low. Your turnover ratios are also done. And all the period ratios are also. How many ratios, beta? We did 7 balance sheet, 7 P&L. Then in mixed ratio, I started with turnover ratio. Turnover ratios, I taught you 6 turnover ratios and I taught you holding period ratio. There were 3 holding. So 14 plus 6, 20 plus 3. How many ratios are done, beta? 23 ratios. Okay. I have told you how many ratios will I do? So 23 ratios clear, beta? Okay. Now I'll tell you there is something which is called as return ratios. Return ratios. Okay. Now in return ratio. I'll teach you one very easy concept how to remember all the return. First of all, what do I mean by the word return? Can I say return ratios means what is the profitability on the investments which I have made? That will help you to calculate the return. Suppose Divya started with Divya Industries Limited. Okay, and she has invested 10 lakh rupees in that and Divya earned a profit of 2 lakh rupees. So what is the percentage of return she has earned on her investment? Come on, Solu, come on. 20%, very easy, common sense questions. 10 lakh rupees she has invested, she has earned a profit of how much? 2 lakhs. So can I say that her returns is nothing but 20%? Come on, yes or no? Yes, sir. Her returns are 20%. So what you have done? You have taken profits in the numerator and you have divided the investments in the denominator. Okay. Now wait. If I talk about your return ratios, there are 3 return ratios which are possible. Okay, how many return ratios are possible? Beta 3. The last one can be modified into post-tax. So 4 return ratios, but 3 main ratios. Okay. So I will first teach you 3 main ratios, starting with return on equity shareholder fund. Then there is something which is called as return on shareholder funds. Then there is something which is called as return on capital employed. Okay. Now please tell me one thing. First of all, is there a difference between return on equity shareholders funds and return on shareholders funds? Solo. In shareholders funds, will there be preference shares? In shareholders funds, will there be preference shares? He's telling no, sir. Shareholders funds, there will be preference shares. In equity shareholders funds, will there be any preference shares? No. Okay. So if I talk about return on equity shareholders funds, can I say the investments we are talking about is equity shareholders? Right? Return on shareholders funds, in the denominator, what will I write down? Shareholders funds, now, because it's return on shareholders funds. So I'll write down shareholders funds. We want to check on this investment. And return on capital employed. What will I write down in the denominator, beta? Capital employed. Okay? Hello? Okay. Now in the numerator, what should? Profit should. In the numerator, what should come, beta? Profits. Profit should, right? Everyone please tell me, when I talk about return on equity shareholder, this is the income statement. So I will give you some options. 1, which profit should we consider? 2, 3, let's play MCQ. These are the 4 options. Now I am talking about return on equity shareholders fund. Return on equity shareholders fund. Of course, we are talking about in the denominator, we are checking equity shareholders funds as an investment. Can you please tell me which profits should I take? Option 1, 2, 3, 4. 1, na? Because when we are talking about return on equity shareholders fund, we are talking about what is the net profits which we have generated from equity shareholders. Net profits available for equity shareholders. Okay. So we are going to check that how much is the profits we have generated for equity shareholders from equity shareholders fund. That's why there is going to be option 1. Okay, getting it? So return on equity shareholders funds, what will come in the numerator, beta? Can I say net profits available for whom? Upon equity shareholders funds. Are you guys understanding? But what about return on shareholders fund? Yeah, so for net profits after tax. Now see, I have already considered first option is closed. Okay. In 2, 3, 4, which option should be for return on shareholders funds? Option 2. Are you all okay? Yes, this is correct, because we are going to see what are the profits available for all the shareholders of the company. That's why can I say we have to take NPAT? Come on, yes or no? You will never forget a formula if you learn it in this. NPAT upon shareholders funds. Correct? Correct? So when we talk about return on equity shareholders funds, imagine the income statement and see which profit should come. So which profits will come, beta? Net profit available for equity share. When I talk about the shareholders, then which profit should come? NPAT should. Now when we talk about return on capital employed is nothing but the money which is invested by shareholders as well as borrowed funds. So how much profits have we generated from their money? Now again I will go here and you have to tell me which option should I select. 4 or 3? 4 or 3? 4 or 3? You can have your opinion. Tell me 4 or 3, everyone, come on. Acha, let me do a poll. How many of you with 4? Raise your hands. 4. 4. Anyone with 3? 3. All are right. So can I say the answer is option 4? Okay, because we are going to check what is the total profit generated from their own money, right? That's why it should be what? EBIT upon capital employed into 100. Hello, yaar. Whatever the profits we have generated from their own capital. That's why it should be EBIT upon capital. Are you all okay with these 3 options, beta? Come on, yaar. So how many types of return ratios are there? 3. First, return on equity shareholders funds. Second, third, okay, numerator comes from, all the profits comes from, numerator comes adjust the numerator coming from denominator coming from balance sheet? Is there a need to adjust the timing difference? So we should take average only if the questions, or else we will always take closing. Okay, but here, because generally these return ratios are always calculated on the closing capitals by the end. Suppose if you want to invest in Reliance, you will take Reliance closing balance sheet and check the returns on that basis. Practical also closing, but if theoretically and conceptually it's a mixed ratio. If they tell you that use average, then should we take average? Come on, yes or no? Yes. Only if they average. But theoretically, I will write down here average. But practically, only if I have to do it, then only. Okay. Now, can you please tell me? I was talking about one modification, return on capital employed. This is also return on capital employed. This is also return. But this is return on capital employed post-tax. Okay. Post-tax. What is post-tax, beta? We want to calculate the return, but after we make the payment of the tax to the government. So anywhere in finance, if you want to make anything from before tax to after tax, you always multiply it by 1 minus tax. So the only difference here will be what, beta? Can I say I'll take EBIT multiplied by 1 minus tax on average capital employed in. On here. Okay. Let me explain you. Let me ask you now again, what are these 4 return rates? First, everyone please tell me return on equity shareholders funds. We are going to divide with what? So what is the division part? What is the division? Equity shareholder fund na yaar. Return on equity shareholders funds will always divide with what? Equity shareholders funds. Return on shareholders funds will divide by shareholders funds. Return on capital employed will divide by. Okay. And now in the numerator, let's talk about the profits. Return on equity shareholders funds. Net profit for equity shareholders. Return on shareholders funds. NPAT. Then return on capital employed. EBIT. Ask you. Awesome. All these return ratios are also done. How many return ratios which we just did? 4. Return ratios are 4. How many ratios? 14 plus 6, 20 plus 3, 23 plus 4. Are we done with 27 ratios till now? 27 ratios are relating to balance sheet, P&L mixed. Everyone clear till here? Okay. Then there is something which is also called as other important ratios, okay, which are not classified in one of these. Okay. And these are also very easy. My students already know this. So aware about called as earning. Come on, Solu yaar. Earning per share. Whenever there is something per share, we always divide by equity shares. If you say number of shares, you will then mix it up with preference shares. So we always calculate earning per share from the equity shareholders perspective. So that's why it should be number of equity shares. But with what will I take in the numerator? Can I say whatever the profits which are generated for equity shareholders? So can I say net profits for equity shareholders? Divide that by number of equity shares. Will this give you EPS? Yaar. So what do you think should be your DPS? Dividend per share. Whatever is your equity dividend, I will divide that with what? Number of equity shares. Will this give me DPS? Yaar? Okay. And the company will always give dividend from the earning. Okay. If you are earning 10 rupees, can you give dividend of 45 rupees? You can only distribute the dividend from what you have earned. Na yaar. So guys, the third ratio which you all should know is called as dividend payout ratio. What is the ratio, Solo? Dividend payout ratio. Dividend payout ratio. Everyone please tell me, if earning per share is 10 rupees and if you are paying a dividend of 7 rupees, how much have you paid? 70%, na? So dividend payout ratio, can I say that will be nothing but DPS by EPS 200. DPS by EPS into 100. Come on, yaar. Will this give you a dividend payout ratio? Come on, yes or no? Dividend payout ratio. EPS by EPS into 100. Dividend payout. How much dividend paying? Maximum dividend payout ratio should be. Can I say 100%, right? Because 100% of earnings you can pay it out by the way of dividends. Okay. If your EPS is again 10 rupees and you have paid 4 rupees by the way of dividends. What's your payout ratio? If dividend is 10, you have paid 6 rupees. Dividend is 10, you have paid 2 rupees. Dividend is equity is 10 and PS is 10 and you have paid 0 dividends. Can I say payout is 0 yaar? So what is the balancing? Retention. The next ratio is your retention. Don't take tension because retention is 1 minus dividend payout ratio. Come on yaar. Okay, retention is nothing but 1 minus dividend payout na yaar. If your dividend payout ratio is 20%, retention is? Dividend payout ratio 30%, retention is? Dividend payout ratio is 90%, retention is? If dividend payout is 100, then retention is? So 1 minus dividend payout, will that give you retention? Come on, yes or no? If you are a CFO of a company who wants to grow and grow and grow and grow, your payout ratio should be dash, lowest, and your retention should be maximum. Everyone okay with this? Okay. Then we have something which is called as have you heard about price earning ratio? Tolu here, price earning ratio. Very important ratio. Price earning ratio formula. EPS by MPS. What is the formula for price earning ratio? MPS by EPS. Price earning. MPS by EPS. Very important ratio. All these ratios are going to come in all the subsequent chapters. That's why I call it as other important. Price earning ratio, MPS by EPS. Everyone in one voice, please. What this ratio tells you? What is the indicator? Someone tell me. What is the indicator? Growth. Yes, beta. Very good. How much number of times a shareholder is willing to pay to earn 1 rupee of EPS? That's called as a P. What is P ratio, beta? How much number of times a shareholder is willing to pay for 1 rupee of EPS? This is an indicator of demand. This is an indicator of willingness. See, many times what happens, market price is an outcome of dash, demand and supply. If suppose people are demanding for a particular company's shares, the share price will go up. So it is an indicator of demand, right? So higher the P ratio, what does it mean, beta? Higher the demand. The demand means, can I say higher the willingness of equity shareholder to pay for that particular share? Come on, yes or no? Yes, sir. P ratio is MPS by EPS. It's an indicator of demand. It's an indicator of demand. If this ratio is higher, means that willingness is also higher. Okay, so P ratio is MPS upon EPS. But you know, one more advantage of P ratio is you can also use to estimate your market price if EPS is given. So you know, in subsequent chapters, you will see that there is EPS. Can I say I can take EPS and multiply that by P ratio to actually get the MPS? Come on, yes or no? Yes. Ratio is MPS. Okay. Last few ratios now. Okay. The sixth ratio, which you should all know, is something which is called as dividend yield ratio. What is it called as? Dividend yield ratio. Okay. The meaning of the word yield is actually your return. So I've covered majority of the ratios in your study module. So what is this ratio? Dividend yield. Yield indicates what? Yield indicates what? Returns. It's returns. Okay. Now everyone, please focus properly. Let's say, for example, you all have already become chartered accountant. What's your good name there? Rahul. Rahul. C. Rahul. Rahul is a chartered. And suppose client comes and the client tells, hey Rahul, I have 1 crore fund. Now I've already retired. I want to invest this 1 crore rupees in some good dividend yield stocks, in some good dividend yielding, that every year I can some dividend which can take care of my retirement expense. Come on, yaar, is this a practical need? Come on, yes or no? Yes. You are like, okay, fine, no problem. You want to invest in stocks and you want to invest in dividend yielding stocks. There are two stocks in front of you. One is Reliance Industries Limited, one is Bhavin Industries Limited. My company. And suppose Reliance Industries Limited has a dividend per share of rupees 10 and Bhavin Industries Limited has dividend per share of rupees 5. You will take your client's money, which company, RIL or BI? Can't answer. You can't answer this question, Mr. Rahul, because it depends upon what is the market price per share. You have to understand that. Suppose market price of Reliance Industries Limited is, let's say, 100 rupees and my company's market price is, let's say, 20 rupees. Now tell me one thing. Which company is yielding more dividend on percentage basis? BIL. Come on, yaar. Because in RIL you can just check, if I take DPS upon MPS into 100, then this is 10%. And this is 5 upon 20 into 100. This is nothing but for 25%. Come on, yaar. So you would like to invest more in which company, beta? BIL. Come on, yes or no? Yes. Because if you take Rahul, your client's money, and if you invest in RIL, then can I say that 1 crore will only yield what? Chalo yaar. So he is just going to get a dividend of what? 10 lakhs. But if you take his 1 crore and invest in my company, then my company will give him a dividend of what? Rupees 25 lakhs. Client will be. So are you going to invest in RIL or BIL? BIL. Everyone got this? So this is a very easy ratio. Whenever we talk about yield, we talk about returns. And whenever we talk about returns, we always compare the dividend per share and divide that by the market price. DPS by MPS. That's it. By MPS. Okay. For dividend distributing companies, it's DPS by MPS. So what should be the formula better? Dividend yield ratio? DPS by MPS into 100. This ratio should be lower the better or higher? Lower or higher? Of course, this ratio should be higher the better, because if this ratio is higher, it indicates what? Higher returns, higher yield. Yield in finance means returns. You always want higher dividend yield. Okay? Purinjida. Okay. Then we have the next ratio. What's the next ratio? What's the next ratio? Earning yield ratio. Okay? Earning yield ratio. Can you please tell me the meaning of the word yield means what? Returns. Now, earning yield ratio will only have one modification. That was dividend yield ratio, so I took DPS upon him. This ratio I should take. Come on, loudly. Yes, by MP. Okay. So, 7 ratios are done. Then we have something which is called as your interest coverage ratio. Which coverage ratio, beta? Interest coverage ratio. Now, what does this ratio tells you? That how much number of times your interest is getting covered from your profits. That is actually called as your interest. How much number of times, how much number of times your interest is getting covered with your EBIT. So that's called as your interest coverage. Okay. The formula for this is dash upon dash. EBIT by interest. Okay, this will help you to understand that what are the number of times your interest is getting covered with your EBIT. Now, because we always pay our interest from EBIT. See, let's say for example, there is A and B. Let us take, there is RIL and BI. Okay. Now, RIL has a EBIT of 100 crores and they want to pay the interest of 50. Suppose I also have to pay the interest of 50, but I have a EBIT of 500 crores. Can you all please tell me that in my case, the interest is getting covered for how many number of times, beta? 5 times. In my case, the interest is getting covered how many number of times? 10 times, na? Because what is my profits? 500 crores. I can pay 50 crore interest 10 times. Hello? I will not pay 10 times, but I'm telling you. I'll pay only one time, but my profits are they are covering my interest for 10 times here. So as a lender, you will give loan to RIL or BIL? Always to me only, okay, everything. So can I say that you will give loan to me? Come on, yes or no? Yes, sir. So that's why this ratio should always be lower the better or higher the better. Higher the better, because there that guy interest is just getting covered 2 times. In my case, the interest is getting covered how many number of times? 10 times. 10 times. So if tomorrow as a lender you want to be more secured, then of course you'll be secured when you give, right? But for more number of times. Okay? So that's why it's EBIT upon interest. Because we always pay our interest from the EBIT. Okay? So can you just refer to this income statement one more time and tell me, see, in interest coverage ratio we took EBIT upon interest because we pay our interest from your EBIT. That's why I took EBIT upon interest, okay, to get the interest. Can you please tell me what should be the formula for then preference dividend coverage ratio? Preference dividend coverage ratio. You only frame the formula and tell me. Very good. It should be NPAT upon preference dividend. Because whenever we are talking about preference dividend coverage ratio, we are talking from the perspective that what is the preference dividend paid from the amount of your NPAT. So we should take NPAT upon preference dividend. Will that give you a preference dividend coverage ratio? Come on, yes or no? Yes, sir. So preference dividend coverage ratio should always and always and always be NPAT upon preference dividend. Preference dividend coverage. NPAT upon preference. Correct? Then what do you think should be equity dividend coverage ratio? Very good. Because we always pay equity dividend from where, beta? Net profits for equity shareholders. So I will take net profits for equity shareholders and divide that with what, beta? Equity dividend. That give you your equity dividend coverage ratio. Come on, yes or no? Yes, sir. All these ratios should be what, beta? Should it be lower the better? Now, this last also asked based on debt service coverage ratio. Are you aware about debt service coverage? Debt service. Okay, so actually 37 ratios gets over here. But one more additional, because I like you guys. There is something which is called as debt service coverage. Now see, what is debt service coverage? So this is as per the RTPM. Debt service. What is debt service? Servicing of debt means repayment of debt. Now see, whenever we talk about whenever for debt service coverage ratio, we are talking about how are we going to meet? How are we going to meet your principal plus interest with the amount of the cash profits which we have? So debt service, see, actually when you take a loan, you are not only going to pay interest. You also have to pay some part of principal also. Na? Have you heard about EMI? Equated monthly installments. Whenever you are paying an EMI, you are paying some part of principal also and some part of interest also. That's how your loan gets over, right? So when we are talking about debt service coverage ratio, we are going to check that how much is the principal along with interest which you have to pay from the profits which you have generated. Okay, so your debt service coverage ratio actually has net profits after tax plus interest and plus the amount of depreciation. First of all, why have I added interest? Because see, I want to see what is the total amount available with me through which I can service a debt, through which I can pay a debt. So in NPAT, automatically interest gets subtracted, right? If interest gets subtracted, I've already reduced that amount, but I want to see what is the amount I have to pay the amount of the loan. So Rahul, don't you think I have to add back the amount of the interest? Come on, yes or no? Yes. So that's why from the NPAT, I will add back the amount of interest. So I can come to know what are the profits I have to pay my principal as well as my interest. So I have to pay principal also, I have to pay interest also. So I need to check what is the profits which I have. And to check what is the profits which I have, in NPAT, interest is already subtracted. So what do I have to do, beta? Add back the amount. Add back the amount of depreciation. That together will give me the total cash profit, which I'm going to divide with what? Principal plus. Will this give me the debt service coverage ratio? Come on, yes or no? Yes, sir. How is this different from the depreciation? Why I'm adding? Because depreciation is a dash, non-cash. So it is reduced from profits, but I have more cash available with me. That's why I add back the amount of depreciation, right? And I divide that with what? But I divide that by principal plus interest. Because that together will help you to understand that what is the loan requirement which I am supposed to. This ratio should always be better, lower the better, or this is higher. And how is it different from interest coverage ratio? Because in interest coverage ratio, we were just checking EBIT and interest. In this ratio, what are we checking, beta? Principal plus interest. That's why I'll take how much is my profits, add depreciation, add interest, and divide that by principal. Got it? This ratio should also be lower the better or higher the better? Higher. All the coverage ratio should always be dash. Superb, awesome, fantastic. So now, how many ratios, beta? Some other important ratios were 11. Together makes a count of what? One bonus rate. Have you all enjoyed this? Okay. Conceptually, have you all understood all the 38 ratios? Because I cannot start with any of until unless I don't help you, make you understand these particular. Know these ratios, then this will also be done. Pranav will do that. We'll do that later. But for the timing from this one, this is something which is, I'll tell you. Because all the questions are based on this ratios. Okay, Pranav? Hey, everyone in Zoom, have you understood this? Give me in chat box your replies, whether you are awake or no. Purinjida. Yes, sir, awake, understood. Are, wow, very good. Yes. Thank you. Chalo, I am so happy to see so wonderful response which is coming from the Zoom students as well. Means that they are really listening to. Or else, majority of times they keep the cameras off and then they're. But very good. Fine. Chalo, best. Now, the time has come for. What break? Okay. No break. Okay. So I'll be starting with, as I've told you, I've divided to these different chapters. And I'll be doing some questions practically as well. Okay, so that you all don't face any problem. And I want you all to do me. Beta. Switch off. Out and ask them. Okay, first, I will start with a very basic. The following information relates to what? Relates X. Okay. For the year ended, okay, best happening in remote there in the center. It's done, but scam is not. No scam in my lecture. Okay. So following information relates to X, because here I just wanted to teach starting basic. We will have to solve this question together. Photo of this. Else I'll tell you where to download. But for the timing, I've kept it here. Following information relates to X. Do you have working capital amount available? Yes. You have fixed. Working capital turnover ratio are required to funds. Can I say proprietors funds are also called as your owners funds? Come on, yes or no? Yes, owners funds. You also have fixed assets, then you have net. Now, boys and girls, are you aware about as your basic accounting? Do you know what is basic accounting? What is equal to what, beta? Basic accounting equation. Assets equal to liability, but I'll just filter it for you. Here we always call it as sources of funds. Tolu yaar, sources of funds equal to what? Application of funds. The funds is now what are the sources? Where do you store your shareholders as well as your borrowed funds? Okay, shareholders as well as borrowed funds. Okay, Rahul's partner, are you paying attention? Rahul's partner, na beta. Shareholders funds. What is your sources of funds, beta? Where are you going to take the money? You are going to take from your shareholders, and we also take the money from your borrowed funds. So sources of funds actually has your shareholder funds plus borrowed funds, and this together is called as your what? Capital employed. What's it called as, ladies and gentlemen? Capital employed. And where do you apply? Assets. So what is the first asset? Fixed assets. Second asset, long-term investment. Third is working capital. What is working capital, beta? CA minus C. This is called as basic accounting. The entire balance sheet. Because you all can just check that where does equity share capital, shareholder fund, borrowed fund, fixed assets, long-term investment, working on where it will come? Shareholders fund. Preference share capital, shareholders fund. Thousands of shareholders fund. Miscellaneous expenditure not written off, we always subtract it. Okay. DF, borrowed fund, which deals with long-term loans, debentures. Will bank overdraft come in borrowed? No. Bank overdraft is long-term or bank overdraft is short-term. If it is short-term, then it always forms part of your current liability. Okay. Kind of short-term debt. Here only. Any kind of short-term debt or current liability or bank overdraft, all this will be classified where, beta? Classified in your working capital. Right? And then when we talk about fixed assets, what are the types of fixed? Plant and machinery, land and building, etc. All these things. Long-term investment. And current assets. Okay. Can a company operate without shareholders? Matlab, when we are talking about financial management, without shareholders, there are CFOs of these. CFOs of the all lands info. In this particular case, I hope you are trying to understand that a company cannot operate without. But is it possible that the company can operate without taking long-term loans? No information is given to you. Can I assume that borrowed funds is nil? Illa, come on. If no information is given to you, then can I assume that there is no borrowed funds? Again, can a company operate without fixed assets? Can you operate without plant and machinery, furniture, fixtures, etc.? Can you operate without that, yaar? But can a company operate without long-term investments? Of course. So if no data is given to you, can a long-term investments be zero? But can a company operate without working capital? No. So my dear students, can I say that your shareholder funds is nothing but fixed assets plus working capital? No data is given. Now, if they give you a ratio, example, fixed assets to proprietors fund. If they give you a ratio of fixed assets to, it means that for every 1 rupee of proprietor, suppose 0.7 is the fixed. Can you all please answer this in one voice and tell me how much is invested in the proprietor, beta? how much is invested by a proprietor? 1. And in that, how much is invested in fixed assets? So how much is invested in working capital? Correct? And if suppose 0.3 is invested in working capital, and if I have the working capital amount available, then can I get my shareholders funds? Come on, yes or no? Yes, sir. Again, I am repeating, if fixed assets to proprietors fund, and if the 0.4:1. So on 1 rupee of proprietor fund, how much is invested in fixed assets? 0.4. Suppose if the ratio is 0.4:1. Can I say on 1 rupee of shareholders, how much is invested in fixed asset? 0.4. How much is invested? 0.6. If the ratio is 0.3:1. On 1 rupee of shareholder, 0.3 is invested in fixed assets. How much is the working capital? Come to this particular ratio. Now tell me, the following is the information. Working capital amount is given. Fixed assets to proprietor fund is 0.75. Everyone in one voice. On 1 rupee of proprietor fund, if 0.75 is invested in fixed assets, what about the balance? What is 0.25? Can I say balance 0.25 is nothing but working capital? Come on, yes or no? Okay, working capital turnover ratio. I've already explained working capital turnover ratio. Very easy to remember. Working capital turnover ratio, dash upon dash. Sales upon working capital. Very good. Average, but if opening is not given to you, can you just write down closing? Yes or no? Yes, sir. Okay. Everyone quickly go to your notebooks and write down. This is my solution to question number 3 and your first question. Chalo, let us write down first as per. We will quickly solve this. As per basic accounting equation. Hello. Shareholder funds is fixed assets plus working capital. Fixed assets plus working capital. Fixed assets plus working capital. Everyone please tell me what is the amount of my shareholders beta. What is the proprietary fixed assets to proprietor fund given to you? Can I say on 1 rupee of shareholder 0.75 is fixed assets? Working capital solo 0.25. Do I have working capital amount? How much is that? What will be the shareholders? Solo 48 lakhs. Come on, yaar. And if shareholders funds is 48 lakhs, what will be your fixed asset? 40. You understood now how you got 48 lakh? 12 lakh into 1. So divide by 0.25. Just making it clear for you. What is the amount of the fixed assets, everyone? 30. Okay. That's what they have asked, right? What is proprietor's fund? That is shareholders fund. What is fixed asset? Fixed. Now what is your net profit ratio? What is your net profit ratio, everyone? I explained you what is net profit ratio in the P&L. Tell me. Dash upon dash. NPAT upon sales, na yaar. Net profits after tax upon. I want to ask. Have sales. You don't have it readily available, but we can calculate. With which ratio will we calculate? Working capital turnover ratio, we can calculate that. Okay. Everyone please tell me what is the formula for working capital turnover ratio. Sales by working capital. What is the turnover ratio, guys? Turnover 5. Do I have the amount of sales? Do I have the amount of working capital? Yes. Can I get my sales? Sales solo. I have this as my amount of sales. Now, ladies and gentlemen, boys and girls, please give me. Do I have the NPAT readily available? The NPAT readily available, or I have to find out the NPAT? NPAT is the figure readily available in the question. Can you see that? Nothing to think, only one figure in rupees was given to you. There is no other data, there is no direct figure given to you, na? You have to derive that figure. We'll derive this figure with the help of which ratio? Everyone loudly, yaar. ROE, return on equity. Return on equity, what's the formula? Dash upon dash. I explained you the logic, now don't tell me. Return on equity, with what do we divide, beta? Equity. Equity is equity shareholder funds, na yaar. What we will take? Net profit available for equity shareholders. Of course, that's your NPAT only, because there are no preference dividend in this. Now, whatever is your NPAT, that itself is net. What is going to be the formula, bacha? Can I say your ROE is nothing but net profit for each shareholders divided by equity shareholder funds into 100? Hello? What's the ROE, guys? How much percent? Let the net profit for equity shareholder be X. Give me equity shareholder funds. 48 lakhs. What is this final answer? 7 lakh? Have I got the net profit for equity shareholder, which itself is nothing but NPAT? No. NPAT. What will I do with this NPAT? Can I go and substitute? Where do you think I should substitute? Can I say I should substitute it here? 7 lakh 20, guys. Hello? How much will be this ratio? To understand. This is the flow of the question. How we should solve it. Whenever you see this kind of a ratio, which is fixed assets to funds, always remember on 1 rupee of your proprietor, 0.75 is the fixed or working capital. Everyone's okay with this much? Okay. One basic question. Okay, very nice. Want you all to please come check. Question number, which is my question. Number 5. Your second question. Solve this question and then we will take a small break. Usually you all take break every 2 hours. That's what I heard. But then after the break, only I will be there in the lecture. I don't want to get break every 2 hours, right? After this question, you want to break. Very clear. After this question, give me a break, else I have 2 calcies in front of me. I'll give you a break after this question. And I'll stretch. I'll leave it up to you. It's okay. He has told me. Huh? Break even point. Okay. Level of saturation. Hey, Zoom students, you are already taking break. You guys are there? Give me yes or no, sir, in the chat box. Come on. You have to keep on responding. Yeah, I'm seeing the chats also simultaneously. Arey wow. Awesome. Very good. Bharat, Samyukta, Kavichitra, Darshana, Ati, Pranavya, Priya, Archana, Bas. Now, ladies and gentlemen, what is the format of the income statement, everyone? How do you start? Sales less COGS. What do you get? Gross profit. Okay, wait. Can I say in COGS the expenses which are there, these are indirect expenses or direct expenses? Because everything regarding your account will be there, right? Now let's read this. X has made plans for the. It is estimated that the company will employ the total assets of 8 lakhs. 50% of the assets which is being financed by borrowed capital with an interest cost of 8%. And the direct costs are estimated at rupees how much? 4 lakh 80. All the other operating expenses is nothing but what? 80,000. The goods will be sold to the customers at 150% of direct cost. Tax rate is assumed to be how much? 50%. You are required to calculate number 1, operating profit margin before tax, net profit after tax, return on operating profits after tax. As Always remember, whenever we have to calculate these type of ratios, we have to start with the income statement, and the income statement will start with dash. Everyone with me will now start solving this question. We'll start with sales, then we'll subtract what? COGS. What do you get? From gross profit, what do you subtract? Operating expense, what do you get? EBIT. Hello? From this, what do you subtract? What do you get? Less. What do you get? From EAT, what do you subtract? Preference dividend, what do you get? Net profit for equity share. Okay. What's the tax rate? Hey, online students, you all can answer in the chat box. Come on, what's the tax rate? What's the tax rate? 50% is the tax rate, right? Okay. Now tell me one thing. Always when things which are the things, come on. You have all the other operating expenses as 80,000. So can I say operating expenses 80,000? Come on, yaar. Then do you have your direct costs which are estimated at 4,80,000? Now direct cost, as I told you, it's nothing but part of your COGS. That will be 4,80,000. Okay. And what's your sales beta? Sales percentage of direct cost. 150% of direct cost. Okay. So then we have to take 4,80,000 into 150%. How much is this coming as? Sorry? 7,20,000. You can directly add 50% also. So if direct cost is 100, sales is 150%. So it's 150. Okay? And 720 minus 480, come on. Very good. Varshini, Pranav, correct answers. Give me what is the answer? 2,40,000. Minus 80, come on. 160. Hey, do you have any amount of loan in this question? Because how much amount is the total assets? 8 lakhs. And from this 8 lakhs, how much is being financed by borrowed? Very good, 4 lakhs. So how much is your shareholders' funds? Awesome. So can I say that what's the rate of interest? So what is 8% of 4 lakh? Very good. 160 minus 32. 128. What's the tax? 50%. 64. What is this? 64. Is there any preference dividend? No. This is 60. Are you all okay, yaar? Now we have to start. What's the first ratio? You are required to calculate what? Operating profit margin. Operating profit margin. Guys, operating profit margin before tax. Matlab we are required to calculate your operating profit ratio, and in operating profit ratio, we always write down in the numerator dash. EBIT is correct. What do we take in the denominator? Very simple, operating profit ratio. Do you have the EBIT? How much is that? 1,60,000. Do you have your sales? How much is that? 7 lakh. 1,60,000 divided by 7,20,000 into 100. Solo. 22.22%. Superb, awesome, fab, fantastic. 22.22%. Then what's the second ratio? What's the second ratio? Net profit margin after tax. Net profit ratio. Everyone in one voice, what's the formula for net profit ratio? NPAT upon sales. 200. NPAT is already after tax. The net profit ratio is NPAT. And NPAT is already after tax. Again, don't do it 1 minus tax. Okay? Do you have NPAT in the question? Do you have NPAT in the question? Just check. Come on, yeah. Do you have NPAT in the question? How much is the NPAT? What I need to do? Take 64,000 and divide that with what? Sales. 7,20,000. 200. Give me the answer. 8%. Third ratio. What's the third ratio? Look at the question. Tell me what's the third ratio? Return on assets. Everyone in one voice, what's the formula for return on assets? Can I say return on assets will be NPAT? Oh, because they have told you on after tax, na? On operating profits after tax. So when they tell you operating profits after tax, you know what is operating profits, beta? EBIT. And if you want to convert that into after tax, what will you do? 1 minus. Okay. If no information is given to you, then it's always NPAT upon assets. But if they give you like this on operating profits after tax, then I have to take EBIT into 1. What's the total divide by assets? Cost assets. What's the total assets, beta? 8 lakhs. What's the amount of EBIT? What's the amount of EBIT? EBIT. 1 lakh 60. Na? So EBIT is 1 lakh 60. I want to convert that into post-tax. So what is post-tax? Tax rate 50%. 1 minus 0.5 into 100. There you touch your calci is 10%. 80,000 divided. Pub. With this, we are done with the third ratio. What's the fourth ratio? Fourth ratio, asset turnover ratio. All my intelligent students know what is asset turnover ratio. Sales by total assets. Come on, yaar. Sales by total assets. Will this give me asset turnover ratio, yaar? Sales by total assets. Can you please tell me what is the amount of the sales, beta? 7 lakh 20. What's the total assets? 8 lakhs. How much number of times? 0. There is no need to do any average because we don't have any open. Rinjida. 90%. Let me be. Turnover ratio should always be in times. Return ratio should always be in percentage. Profit ratio, percentage. Balance sheet ratio, always in pure numbers. 1. Okay. And coverage ratio also in times. It's not 9 times per 0.9. Understood this? Okay. Always remember that your suffix is very important. If you write down 0.9%, this is not correct. Tell me the next ratio. Return on owner's equity. Everyone in one voice. Return on owner's equity. Return on owner's equity will now be owner's equity. Equity means what? Equity shareholders funds. So I have to divide that by equity shareholders funds, multiplied that by 100. What should come in the numerator? Net profits available for equity shareholders. Divide by equity shareholders. Very simple. If you know the ratios, are you understanding? Application is very simple. Give me equity shareholder funds. Look here, give me equity shareholders funds, 4 lakhs. Right? And what is the net profit available for equity shareholders? 64. On 4. Now this is the returns. Na? Return should always be in percentage. Bharat multiplied by 100. How much is this? This week. Okay, boss. Have you all understood this? Now, stop. Don't be late. Okay? It's 11:33. Start at 11:48. Stop. 10:50. Online students, 10:50. Check.